Hello traders. Welcome back to my channel. If you've ever traded with the smart money concept, you've definitely heard of the two most crucial concepts: the order block and the fair value gap. These are the two entry points that smart money targets. But here is the problem. When both an order block and a fair value gap appear close to each other, which one should you choose? If you choose incorrectly, you could be stopped out immediately. But if you choose correctly, you will get a setup with an extremely attractive risk-to-reward ratio. Today we are going to settle this question once and for all. We will not only define them, but also provide the 3 golden criteria to filter for the highest quality setups. After that, I will reveal my personal choice and why I prioritize it. Let's dive right in by clearly understanding the nature of each concept. First, let's talk about the fair value gap, also known as the price imbalance zone. A fair value gap is simply a gap on the chart, created by a sudden and aggressive price push. Technically, it is the distance between the wick of the first candle and the wick of the third candle, skipping the candle in the middle. This gap indicates that the market is imbalanced in terms of supply and demand. And following the natural principle of the market, the price tends to return to this FVG zone to fill it, or mitigate it, before continuing the main trend. If you enter a trade at the key zone, within a fair value gap, the FVG allows us to place a tight stop loss, which typically results in a high risk-reward ratio. However, entering a trade early at the FVG can be prone to failure, because the price may trade through the FVG before the actual reversal. Next is the order block. If the FVG is a sign of imbalance, then the order block is the very origin of that imbalance. The order block is the last opposite-colored candle, immediately before an aggressive price push that creates the FVG and breaks the market structure. The order block represents the spot where large institutions, smart money, placed their final, massive buy or sell orders. When the price returns to this order block area, the remaining orders, pending orders, or protective orders are activated, causing the price to be pushed away aggressively. If you enter a trade when price reacts at a key zone and you place your stop loss outside the order block, your stop becomes much wider. But in this case it still feels safer than using an FVG stop. So, how do we filter out the OBs and FVGs that are truly valuable instead of just noise? Let's move on to the 3 golden criteria in the next section. The first golden criterion must be accompanied by a break of structure. An OB or FVG only holds high value when it is created by a price action that has broken the previous market structure. This means the price push must be strong enough to break the nearest swing high or swing low. This break confirms that momentum has shifted, and the buying-selling pressure in this OB-FVG area is real, not just a temporary reaction. The second golden criterion must sweep liquidity. Smart money doesn't just trade, they hunt. They need liquidity, which is the stop-loss orders of retail traders. Therefore, a great setup is when your OB or FVG is located in an area where the price has clearly swept through a distinct liquidity zone, such as equal highs or equal lows. This indicates that the fuel, the stop-loss orders, has been collected, increasing the likelihood that the price will aggressively reverse from your area. The third golden criterion must be in the right price area. Imagine you're shopping. You want to buy at a cheap price and sell at an expensive price. The market is the same. For a buy trade, your OB-FVG must be in the discount zone, meaning below the 50% level of the recent price wave. For a sell trade, your OB-FVG must be in the premium zone, meaning above the 50% level of the recent price wave. If an OB-FVG doesn't meet this criterion, you must skip it. Now that we have mastered the filtering rules, let's put the order block and the fair value gap head-to-head to see how they differ when applied in practice. Regarding accuracy, the order block is generally considered more reliable, as it represents the large supply-demand source where institutional orders are triggered. The FVG is more susceptible to price penetration. Regarding stop-loss placement, this is a crucial point. With the order block, you have a clear boundary for placing your stop-loss, usually just outside the body of the OB candle. This provides safety. Conversely, the FVG allows you to enter a trade earlier, leading to a higher risk-reward ratio, but at the expense of lower safety. You can easily get stopped out just by a slight price sweep. Regarding frequency of appearance, the FVG appears very frequently during price pushes. The order block appears less often, but each appearance is typically of higher quality. So, based on these comparisons, what is the optimal choice for smart money? Let's move on to our conclusion and a practical example. Examples. Here you can see a strong impulse that breaks through the previous level. That move leaves behind a large FVG and an order block way down below. When price retraces, it only taps the upper premium zone of the FVG before bouncing back up. But taking a trade in this area is risky. The reaction is shallow and momentum can easily shift against you. Now here's another example. A bearish leg creates several impulses, leaving both OBs and FVGs along the way. When price comes back, notice how it tests and reacts off the FVG zones that sit very close to the OBs. These FVGs act like magnets, especially when they're aligned with nearby structure. And in this last case, price retraces deeper. It gives a small reaction at the FVG, then breaks through it and completely sweeps the OB before continuing the trend. This happens when liquidity builds up below the OB, so the market digs into that area to collect orders before moving back in the original direction. Okay, so we've compared FVG and OB. I hope this video gave you a clearer perspective on how to choose your entry points using the smart money concept. The most important thing is this: keep learning and test everything for yourself. If you found this content helpful, don't forget to hit the like button and subscribe so you won't miss our next in-depth analysis videos. Wishing you successful trading. I'll see you in the next video.